It's July 25th, 2007. Our trader for today is going to trade the E-mini NASDAQ 100 contract. He has on his chart the volume distribution function shown here on the left, and he knows where the peak volume price is at 20.30.75, and the volume weighted average price is at 20.24.16, so the market's skewed to the downside. This means he's going to take a short, and he's going to look for a short at the first standard deviation of the VWAP, which is around 2017.25, so he'll look for an entry at around 2017. He'll want to take his profit target to the second standard deviation at 20.10.21. That'd be a nice profit. The NASDAQ trades $20 per point, so one tick is $5, a tick being a quarter of a point. So let's see if he can get into this trade. 2017, he'll look for an entry there, and he'll then try and take a profit down at the second standard deviation. His stop loss will be up at the peak volume price at 20.30.75, or one tick above that, 20.31. So let's see how he does here. He has to keep in mind that he knows what his risk tolerance is for a trade like this. It is fairly large because we have a fairly large standard deviation going into this, but he's willing to take that kind of risk to make the profit that he wants. Okay, we're in the trade. 2017. That's his entry point. 2017. So let's put that on here. There is his entry point, and his profit target will be down at 2010, so we'll go one tick above that, 20.10.25. Okay, but now he notices market's moving up against him quickly. What's he to do? Well, he knows he can also take trades at the VWAP, so he will not exit this trade, even though it looks like a loser at the moment. What he'll do if the price reaches the VWAP is he will short again, enter with a second contract, and that should be around 20.23.75 would be a good place to try this. So he'll wait until price moves up to that point, and he'll short a second contract. Now, why is he doing this? Well, he knows he can take trades at VWAP. He's been doing that over and over in his head, and also with real money. He knows he takes trades at VWAP. They're usually successful, so why not here? He'll be short two contracts instead of one, and it should be a safe trade for him. This is called scaling in, and it's a legitimate scale in. It's not just an arbitrary scale in. He's taking a trade at a point which he would normally take a trade at, Even though he already is in a one contract trade at the first standard deviation, there's no reason why he shouldn't enter it with a second contract at the VWAP. Market is skewed to the downside, and he knows that his expectation is for the market to remain to the downside because of the skew. And his expectation is, if it hits the VWAP, that the first standard deviation would be an expected move from that point. He's trading volatility, and the volatility indicates that the first standard deviation at the moment is at 2017, and so that's where he would expect the market to move if in fact price moves back to the VWAP, which it looks like it may be doing. The moment that price is at 2021 and a quarter, so he's still in the trade. He has not exited, even though the market has moved 4 points against him, which would be 80 bucks. He's staying in here and waiting for a new entry for a second contract. 2023.75. In fact, he should move it down a tick to 2023.50. Since the VWAP has moved down. So let's put his entry target there. VWAP is now 2023.71 or thereabouts. So an entry at 2023.50 would be a good entry point for that second contract. And looks like that price has moved up quite a bit from his original entry down here at 2017. And he should get a fill if the market moves to the VWAP. If it does not, of course, then his expectation is the market should just simply move back down again. So he'll wait. He won't pull the trigger early. You don't want to get into a scale in early. You want to get in where you expect a favorable trade in the direction that you think the market's going to move. Nothing else is happening. Peak volume price being up here at 2030.75, it doesn't look like anything else is developing of any consequence below that. So it looks like the market will stay skewed to the downside, and at some point this trade should work out for him, even though he is apparently in a losing trade. He's in a losing trade by about 5 points, about $100. No big deal. His risk tolerance is a lot larger than that. He knows what his risk tolerance is. Typically, traders take a risk tolerance equal to 2% of their account. So if he has a large enough account, he can certainly afford a 2% loss on this particular trade. If in fact the market continues to move up well beyond the VWAP up to the peak volume price. So he'll just wait and see what happens here. He's still waiting for the market to come up to 2023.54, 2023.50, which would be his entrance on a second contract, 2023.50, and it looks like he will probably get a fill there. We're at 2023, 23 and a quarter. 23 and a quarter still, 23.50. We've touched that. You get one more tick up here, 23.50. There you go, 23.75. So he's filled at 23.50. His initial contract was at 2017, so that is a difference of 6.5 points, and so his break even on these two contracts is half that, or 3.25 points above the 2017. So let's put his break even in here. That would be 20.20 and a quarter. If you wanted to bail out of this thing entirely, you should bail out with at least one tick profit. So let's give him his one tick right there, 20.20. Okay, we're in with two contracts. First contract at 2017, second contract at 2023.50. Break even plus one tick or minus one tick is 20.20. He has two choices. He can exit both contracts at 20.20 and end up with a profit of 2 ticks. Or he can simply exit one contract. Actually, he has three choices. He can exit one contract at 20.20 and then hold on to the second contract until it gets back to his initial entry, which would also give him a nice profit. Or he can hold on to both contracts all the way down to 2017. Any of those choices are viable, and any one of them will make him profitable for this trade. Market's still moving up. We're up to 2027, the high here. Expectation is still for this market to move down, and our trader will attempt to take off one contract at 20.20, and I would venture to guess he ought to take off his second contract one tick above his entry here, one tick above the present value of the standard deviation, which is about 2017, so about 2017 and a quarter would be a good exit target at the moment. Depending how long it takes for the market to come down, he may want to raise that final profit target to another tick or two above that. So the market's at his second entry, and he hopes this will hold, that the VWAP will hold here, and that he'll be able to make a profit on these two contracts. He's been in the trade since about 10:56, so it's now 11:06. So he's been in the trade 10 minutes. Not too bad. Skew is to the downside, and there's every reason for him to believe that the market will head back down again. There's no particular evidence to indicate that this market is going to suddenly zoom up to the peak volume price or beyond. And he has a risk tolerance which is large enough to tolerate these kinds of moves. Otherwise he wouldn't take this kind of trade. That's the nature of scaling in. If you have a risk tolerance that's large enough, you can do scale-ins. You can trade 1, 2, 3, as many contracts as you feel comfortable with in a scale-in type trade, as long as the scale-ins are at points which make sense from the point of view of the volume distribution function. If the scale-in does not make sense, then you're only kidding yourself. You would not, for example, want to scale in up here. This is in a region which our trader doesn't know anything about, at least not yet. So he shouldn't be comfortable about allowing prices to move up into this region and still be scaling into a short trade. But scaling in down at the VWAP is a perfectly good method for trying to get a profit out of the market. And let's face it, that's what we're here for, to take money off the table on every trade, even those that look like they're losers. So here we have the market coming back down again. It went above the VWAP up to 2027, but then fell back in accord with expectation based on the volume distribution function, the skew, and we're waiting for prices to come to 2020, at which point our trader will take one contract off the table. That is break even minus one tick, so he will make one tick on that contract. If we get to 2020, there's no reason to expect otherwise. Again, the peak volume price being up here, there's nothing even remotely close to that peak in volume anywhere down in the high volume region, all the way down to the low. So he does expect that this market will eventually move back down to the first standard deviation down at 2017-24. And that being the case, it has moved up, as you can see from his initial entry, which was here. The first standard deviation was 2016-85, and now it's 2017-24. So he should actually move his profit target up yet another tick. So we'll move it up to 2050. Okay? That'll still give him a profit on that second contract of about 2.5 points, which is a reasonable profit. Would end up being a good trade. So the market's hovering around the VWAP, and these places where the market sort of pauses or hangs out or holds up are called HUP, hold-up prices. All the standard deviations, the VWAP, the peak volume price, are all hold-up prices. They're places where markets tend to pause or slow down before deciding whether they will continue in the same direction or reverse and go in the opposite direction. And you need to know where these HUPs are located on your chart. At the moment we have, in addition to the peak volume price, we have the VWAP, the first standard deviation, and the second standard deviation. So that's 1, 2, 3, 4, and then there's these standard deviations here, 5, and second standard deviation here, which is 6. You can also consider the opening price as a HUP, a hold-up price, as well as the previous day's close as a hold-up price, as well as yesterday's high and yesterday's low as hold-up prices. These are all points where the market will pause and maybe reverse, and you should put those on your chart. In a future thread, we'll talk more about HUP and how it will influence your trading patterns and what you should be looking for in the vicinity of HUP. But for now, we just have the VWAP and its standard deviations from today on the chart and nothing else. That's all we're trading against. We really don't need anything else at the moment. But we're going to want some finer detail to aid us in understanding what price action is all about, why markets go through these gyrations, why they pause, why they sometimes continue on in the same direction, or other times they actually reverse at the hold-up prices. All that is understandable in terms of the volume distribution function and its volume weighted average prices and their standard deviations. So we're still waiting here. The market is sort of paused at the VWAP, not doing very much, doing a few oscillations about that. We're looking for a down move here, back down to 2020. We're in the trade with 2 contracts, and the break-even point is at 2020. Actually, the break-even is 1 tick above that. So, if we can get out at 2020, we'll have a 1 tick profit on 1 contract. And we're at 2020 and a quarter, 2020.50. Let's see if this will move down to 2020. Bouncing around a little bit here. 2020 and a quarter. 2020. There we go. We're going to get below that. 1 more tick. Guarantee a fill. 2020. There we are. 1 contract off the table with 1 tick profit. And now we're looking for another tick profit. 2017.50. Another profit for the 2nd contract. And we get a fill at 2017.50. 2018.50. Come on down. Show us your stuff. 2019 and a quarter. Moving back up. This is the typical rotations that market go through. They rotate down, they rotate up, they gyrate around. That's what markets do. Rotation is the name of the game. There was no rotation, you would see all red bars or all green bars. But you have mixtures of reds and greens, all interspersed. Market is rotating all the time. First one direction, then the other, on just about every time scale you can imagine. So let's see if this thing is going to rotate back down again. 2019.75. Let's see if we can get a 2017.50 fill on this thing. We have to get to 2017 and a quarter to get that fill. Let's see if that's possible. 2017.50, there we go. 2017 and a quarter. Okay. We're out of the trade. So our trader has made a profit on 2 contracts. To summarize, he took an entry initially here. At this point, on the first standard deviation, trade looks like it was going to be a loser, and any new trader or inexperienced trader would have probably dumped this trade long before it got up to the VWAP. But our trader, being experienced with market statistics, held on and entered a second contract at the VWAP, and then took a one-tick profit on one contract down at 2020 and finished the trade by exiting at the first standard deviation, making a profit on both contracts. So what seemed to be a loser to start with turns out to be a winner in both cases. Okay, hope this explains something about scaling in ideas, and that you can feel comfortable doing this once you understand that scaling in can be beneficial and can always be profitable. Have a good one.